Thank you all for dialing in. Welcome to today's Australian Economy Update webinar, co-hosted by CBA and AustCham. My name is Jeanette Lu. I'm a Director of China Client Solutions in CBA Beijing branch. I will be today's moderator, also the facilitator for the Q&A session. Let me introduce our key speaker today, Stephen Halmarick. Stephen is CBA Group's Chief Economist and Head of Global Economic and Markets Research. He is based in Sydney, Australia. He will give us an insightful presentation on the Australian economy shortly. We are delighted to have Ming Cao, Managing Director of CBA Greater China and Chief Executive of CBA China, Simon Wu, CEO and Executive Director of AustCham Shanghai, and Stephanie Evenet, Chief Executive, AustCham Hong Kong, to deliver us with opening remarks. I will now hand over to Ming.
Thank you, Jeanette. A very good afternoon to all who has joined us. Welcome to today's webinar jointly organized by Commonwealth Bank of Australia, CBA, and AustCham Greater China. If my memory serves me right, I think the pandemic does make timeline studies sometimes. This would be the third year of joint collaboration between CBA and AustCham in providing the Greater China community that has ties, links, interest in Australia with the latest development and updates on Australian economy. As the largest lender in Australia, it is CBA's purpose to build a brighter future for all. It is hence my sincere hope that today's Australia Economic Update by CBA's very own Chief Economist, Stephen Halmarick, will help us not only to stay informed, but also provide insights to help navigate through the interesting times ahead. So once again, on behalf of CBA, a very warm welcome. Over to you, Simon.
Thank you, Ming. It's always a pleasure to be working with you. So good afternoon, everyone, and thank you for joining us. As mentioned, I'm Simon Woods, the CEO and Executive Director for the Australian Chamber of Commerce in Shanghai, or AustCham Shanghai. So it's great to be working with our Platinum member, the Commonwealth Bank of Australia, on this economic briefing, along with AustCham Hong Kong and AustCham Beijing. So every year the economy is a very hot topic, but I feel this year we're following it even closer. So AustCham Shanghai is very eager to keep people up to date, and this is one of the ways of working with our Platinum members to do so. So I just returned from Australia. We assisted the Shanghai Vice Mayor delegation event in Melbourne, and things in Australia are definitely interesting and changed compared to prior to the pandemic. And I'm keen to hear from a professional's insight into the topic. So on behalf of AustCham Shanghai and our members, thank you to Stephen, our main speaker today, and I'm sure everyone will learn something from today's session. So I'll quickly pass to Stephanie, the Chief Executive for AustCham Hong Kong, to say a few words as well. Thank you.
Simon, and from AustCham Hong Kong, welcome to our members and friends in Hong Kong, across mainland China and in Australia. As many of you know, Hong Kong has Australia's largest commercial presence in Asia and is the second largest Australian population offshore and an important source of FDI to Australia. The links between Australian and Hong Kong people and our economies are important, and what we'll hear today about the economic realities for business and individuals in Australia will have an impact here. Commonwealth Bank of Australia is a founding member of AustCham Hong Kong, joining us way back in 1987. And today, CBA are one of our most important members, sustaining the Chamber as a Platinum patron and sharing with us their deep insights and expertise across financial markets, like today's event. AustCham Hong Kong represents more than 235 companies and more than 900 individuals and maintains our mission to connect, engage and represent our members across Hong Kong and Australia. We are part of the AustCham Greater China network with Beijing and Shanghai, and with them provide extensive support to our members throughout Greater China and Australia. We're thrilled to co-host this event today with Simon and Rex in Beijing. I recall the first opportunity I had to hear from Stephen was in mid-2021, and I can assure all of our listeners today that you're in for a fantastic seminar. It's my pleasure to welcome Stephen Halmarick, Commonwealth Bank's Chief Economist, to the event today. Over to you, Stephen.
Well, good afternoon, everybody. Thank you very much for that kind introduction, Stephanie, and thank you to Jeanette, Ming and Simon, but also a big thank you to all the clients on the call. So we really appreciate your valuable time. And so it's my pleasure to deliver an update on the Australian economy today. As mentioned, my name's Stephen Halmarick. I'm the Chief Economist and the Head of Global Economic and Market Research for Commonwealth Bank here in Australia. And so I'm going to provide a bit of a snapshot on what we think is driving the Australian economy, what are the key developments, and what we think the outlook is for policy and the economy from here. Now, of course, when we're talking about Australia, we have to set the global scene first. Australia is a relatively small, very open economy. And so what's happening around the world is certainly very critical for us here in Australia. And of course, no region more important than Greater China in terms of a big impact on the Australian economy. So let me just set the scene with some thoughts on the global economy, and then we'll turn our mind to Australia. And I'm very happy to take some questions later on as well. So here we have a chart of the key developments for the global economy. Now, as I'm sure everybody is aware, we look at the chart in the middle here. Really, the key driving event has been this surge in inflation. Now, China itself, as I'm sure many are aware, is a bit of in a different position. But if we look across what we might call, the Western economies, here, the US, the UK, Europe, Canada, New Zealand, and Australia, the surge in inflation has been very consistent across just about every country. Even Japan, of course, has seen a bit of an increase in inflation recently. So there's clearly some global factors at play here. And of course, the global factor at play is everybody's gone through the pandemic, and the policy response to the pandemic was quite similar across most of the major developed world, which was shut down the movement of people, launch large-scale fiscal policy easing, and ultra-easy monetary policy, interest rates down to zero, if not a bit lower, and large-scale quantitative easing. And of course, that was happening at the same time as global supply chains were being significantly affected by shutdowns of the pandemic, quite specifically developments there in China, and also Russia's invasion of Ukraine. Now, the good news is, of course, as we can see from that chart in the middle, is that the global inflation pressures have clearly moderating, quite significantly so. Even here in Australia, the annual rate of inflation is now down at 6% from a peak of 7.8% at the end of last year. Now, 6% is still a long way from the target range, which is 2 to 3%. But certainly beginning to come down. Now, of course, as everybody's aware, the monetary policy response to the surge in inflation has also been very consistent across the major developed economies, central banks raising interest rates. And you can see from that chart on the left that although each central bank has a slightly different timing, a slightly different increase in rates, they really all have followed a very similar pattern. But we are relatively confident that in some of the major economies, the monetary policy tightening cycle is now at an end. So we are expecting no more rate hikes from the US Federal Reserve and no more rate hikes from the Reserve Bank of Australia. Similarly, the Reserve Bank of New Zealand is finished. We're expecting a rate hike from the Bank of England tonight, and that's likely to be the last one, and another one from the European Central Bank in September. So by the time we get to September, it's fair to say that all the major central banks are likely to have been finished in their tightening policy cycle. Of course, in China, it's quite different, where the PBOC has been easing monetary policy to support growth. So what we're going to see on global economic growth is a slowdown in the pace of global economic growth this year to 2.4% and next year 2.1%. We're expecting the US, the UK, Europe, Japan, Canada, and New Zealand to all be either in recession or very close to recessionary conditions. So in fact, the major source of economic growth for the global economy this year and next year is likely to be China, although growth in China a little bit slower around the government's target of 5%. The other major factor that I mentioned is global supply chains. So on the chart on the left here, the blue line is created by the New York Federal Reserve. They call it the Global Supply Chain Pressure Index. So it's a measure of global supply chains. 0 is a normal global supply chain. This is the blue line. So the higher the number, the worse global supply chains are. And you can see an initial spike with the arrival of COVID, some improvement, and then a bigger spike higher, particularly related around Russia's invasion of Ukraine and the COVID zero policy there in China. Now, we can see that those global supply chains have improved significantly in recent months as China is opening up and the rest of the world has been improving its supply chain. And the red line in that chart on the left is the cost of shipping a container around the world. And you can see that cost, having initially spiked up, has now come back to almost to pre-COVID levels. So a good example of that is the price of some of these big commodities, oil and gas, coal and iron ore. And we had some initial big spikes higher, and now those prices are returning to more normal levels. So that's really helping the global economy move to a lower inflation environment. The other big factor that's going to continue to dominate the global economy is the move to a lower carbon future. So policies designed around reducing carbon intensity and improving or meeting the net zero by 2050 or 2060 targets of the major economies. Now, here in Australia or within the Commonwealth Bank, this is a significant focus for us. Our tagline is we're banking the transition, helping Australian companies transition to a lower carbon future. And we're also doing considerable amount of research in this space in what we call sustainable economics. Now, these charts are just illustrations of the fact that the money required to help the world and Australia move to a lower carbon future is beginning to flow. And so there's a big increase in finance of projects designed to help us reach our net zero by 2050 targets. So certainly the global economy dominated by this big increase in inflation, monetary policy tightening to control that inflation, and policies around the move to a lower carbon future, going to continue to dominate for quite a number of years. So slower economic growth this year, a bit slower next year as the world transitions through that tighter monetary policy setting. So that's sorry, I should just add, an interesting development is, what is the role for Australia in helping the world move to a lower carbon future? As I'm sure many people know, Australia is a big exporter of some large commodities, and a large share of those commodities, of course, are exported to China. China remains our largest trading partner, taking a bit under 40% of all our exports. Now, the opportunity for Australia is that we are lucky enough to have some significant access to some of the key metals and minerals required for the transition in the global economy. So metals and minerals required for things like solar panels, battery technology, so things like lithium, manganese, rare earths. Now, at the moment, as I'm sure many of you are aware, China has a very dominant position in the export of many of these metals and minerals. But Australia, in fact, has a large share of the deposits of those metals and minerals. The chart on the right, I would highlight lithium. Around 50% of the world's deposits of lithium can be found here in Australia. And so Australia currently exports around about 4% of the global supply of these metals and minerals. So there's actually a big opportunity for Australia to continue to diversify its mining operations into these metals and minerals required to help the world transition. So I think that's a great opportunity here for Australia and China to continue to work together on the development of these key metals and minerals to help the world on the journey to a lower carbon future. So the Australian mining sector is very large now, a very significant part of our export sector, is my view, has a very bright future as it transitions to the mining of metals and minerals required to help the world move to a lower carbon future. So let's drill in a bit more on what's happening here in Australia. And I should mention at the start that here at Commonwealth Bank, we are very fortunate to be able to access internally generated data to provide insights on the Australian economy. So what do I mean by that? So the Commonwealth Bank, as you may know, is the largest bank in Australia. We see somewhere between 30 and 40% of every financial transaction every day. 30 to 40% of every financial transaction in Australia flows through the Commonwealth Bank. And in the research team that I run, we get access to the anonymized and aggregated data. So things like credit card and debit card spending, income being deposited into bank accounts, the level of savings, and the amount of lending that we're doing. So this data is very large data sets, and it comes to me quite quickly. So it gives us really great insights into what's happening in the economy very quickly. Now, the Australian economy grew very strongly in 2022, up 3.7%. Once we were through the worst of the COVID lockdowns, Australians were allowed out. We spent a lot of money. So we had a very strong recovery in 2022. The best place to see that is in the labour market. The labour market was very strong through 2022 and has actually continued that strength through the first half of this year. So the unemployment rate is currently at 3.5%. That's close to the lowest unemployment rate in 50 years. It's the lowest unemployment rate since 1974. So a really great outcome. But we do expect things to change over the remainder of this year and through next year. We have the pace of GDP growth slowing to 1.4% this year and next year, and the unemployment rate to head towards 4.5% by around about this time next year. So let's examine what's happening there. Firstly, on the labour market. So we can see on the left-hand side, whether we look at the unemployment rate, the underemployment rate, or the underutilisation rate, the unemployment rate is very low, the labour market's very tight. But there are some signs of it beginning to soften around the edges. We can see from the chart in the middle here that the number of job advertisements has coming off very high levels, come down a little bit, and the number of people applying for each job is beginning to rise. Now, the big change is our population growth. So I'm sure people are aware that every year Australia traditionally has seen quite a large amount of net migration into Australia. On average, around about 235,000 people migrated to Australia every year. Of course, during the COVID period, that was zero. Well, in fact, it was less than zero, so more people were leaving than arriving. But the population, the net migration numbers now are recovering very, very quickly. And this year, we're expecting over 400,000. So pre-COVID, 235,000. This year, 400,000. A large percentage of those new net migrants are foreign students. And China is providing a significant share of those foreign students. So the foreign student market is strong. People who are coming here will more likely than not want to get a job, and so they'll be employed in things like the hospitality sector, the agricultural sector, as well as the high-skilled professional sector. So this big surge in population is likely to see the labour market continue to soften over the next year or so. Now, during the COVID period, the government provided significant stimulus into the economy, and people saved a lot of that money. In fact, savings increased by $280 billion through COVID. And you can see the chart on the left, the annual savings rate increased very sharply. But it's now been declining, so people are saving less. And importantly, if we look at the chart in the middle, that provides an indication of who has the savings in Australia. And it's very clear that the older generations, 55 and above, have the vast bulk of the savings. And younger people, 15 to 55, well, certainly 15 to early 40s, have almost no savings at all. 45 to 54, a little bit of savings, but it's older Australians who have the bulk of the savings. So that's really important when we start talking about what's happening in the housing market and the rental market, is that people who are more likely to have a mortgage or renting do not have a large pool of savings. So let's talk about that now. So a rough rule of thumb here in Australia is that about 1/3 of all households own their own home. So they're not paying a mortgage, they're not renting. About 1/3 have a mortgage and about 1/3 rent. So it's almost equally divided between 1/3 no mortgage, 1/3 with a mortgage, 1/3 renting. Now, if we look at the chart in the middle here, we can see that the scheduled repayments for mortgages have increased significantly. And that is, of course, because interest rates have gone up a long way. 400 basis point increase in the cash rate from 0.1% to 4.1% from May to now. And so people with a mortgage are having to pay a significant amount more to service that mortgage. Now, there's some lags involved here. Between the time the Reserve Bank raises interest rates and the time you are actually paying that higher interest rate on your mortgage is 3 months. And so the red line here is what the level of interest rates would indicate people should be repaying. The blue line is what they're currently repaying. The difference is just the lag. So the last rate rise from the Reserve Bank was in June. So that interest rate will not be paid until September. So over coming months, the blue line is going to increase to meet the red line. So there's a significant tightening of monetary policy still to flow through to the economy. The chart on the right is rents, and you can see that for the people who are renting, those rents on average are increasing by more than 10% annual rate. So 2/3 of households, mortgage holders and renters, are facing a significant increase in their cost of housing. So that's summed up by the chart on the left. Because the labour market is very strong, we can see that wages and salaries being paid are up around about 10% on the year. So a very strong increase in the amount of wages and salaries being paid. But if we look at the blue line in that chart on the left, the real household disposable income. So that is people's income after you take account of higher inflation, after you take account of taxes paid, and after you take account of interest costs. And you can see that's declining at almost 5% annual rate, the weakest in a number of decades. So even though the labour market's very strong and wages growth's been accelerating, higher inflation, higher taxes, higher interest rates eating into that income so that people's disposable income is actually falling. And that's why the economy is under pressure. why economic growth is going to be weaker. Now, interestingly, whilst the pace of growth is slowing, the government's budget position is very strong, because the major source of revenue for the government is income tax, where the labour market's strong, and company tax, particularly in the mining sector, where commodity prices have been strong. So we are now back into a budget surplus. For financial year 2023, the government has achieved a surplus, which is much better position than previously expected. And here, it's the contrast with the United States is very stark. As I'm sure people are aware, earlier this week, Fitch credit rating agency downgraded the US credit rating. So we had some questions about whether Australia was in a similar position, and the answer is definitely not. We are running budget surpluses and also a current account surplus. So the position relative to the US is very, very different. They're running large budget deficits and large current account deficits. So Australia looks in pretty good shape with regard to its AAA credit rating. Now, as the cost of mortgages are rising and the cost of rent is rising, we think the biggest impact is going to be on the consumer. And here we have some of the internally generated data. So this is spending on Commonwealth Bank credit and debit cards. And we can see from the chart on the left and the chart in the middle that the pace of spending on Commonwealth Bank cards has moderated very significantly, from around about 30% annual rate down to 10% annual rate. And that's nominal dollars spending. So when you take account of inflation, the pace of spending is very low. And we can see on the right-hand side things like household furnishings and equipment, clothing and footwear. Spending is very weak. The annual growth rate's about 0. Also, a big slowdown in the annual growth rate in things like eating out and recreation. So definitely some very clear signs that consumer spending is softening, and we think that trend is going to continue. The way I think about it is income growth is rising, but nowhere near enough to offset higher interest rates and higher rent. So people are going to have to spend more and more of their money on housing, spend more and more of their money on housing, which means just less money to spend on everything else, all those consumer discretionary items and even some essentials. Now, one source of strength for the economy has been business investment. So you can see on the chart on the left-hand side that non-mining capital expenditure plans are actually quite strong. And there's been a small pickup in mining as well. What I don't have a chart of here is also government infrastructure spending is very strong. Most of that infrastructure is funded by the state governments. There's some very large transport infrastructure projects underway, road and rail in particular, as well as some very large energy generating projects, hydro and things like solar and wind. So on the chart on the right-hand side, you can see business lending, although coming a little bit off the highs, is still very, very strong. So this is going to be a source of growth. Another source of growth is our export sector. As I mentioned earlier, of course, China is our largest trading partner. And our export sector has been growing very strongly, due largely to the higher commodity prices that have been evident, particularly after the Russian invasion of Ukraine. So we're running persistent trade surpluses and persistent current account surpluses, and that's a good source of growth for the economy as well. So if we think about the contributions to growth, we've got a weaker consumer, but solid business investment and strong export sector. So we are not forecasting a recession here in Australia. So that's the contrast to other economies like the US and even our friends over in New Zealand. So let's now talk a little bit more about inflation. So you can see from this series of charts, particularly the chart on the right, on the left, a big surge in the rate of inflation. Now, the Reserve Bank of Australia targets inflation between 2 and 3%. 2 and 3% band average over time. So in late 2022, the inflation rate peaked at 7.8%. As of the June quarter, it's 6%. So it's clearly coming off a bit, but still remains quite high. And if you look at these charts, you can see goods price inflation was surged very significantly, as now coming down a bit, but services inflation still remains quite high. Traded inflation and non-traded inflation also quite high. There's a new monthly consumer price index indicator, and we look at the chart on the right, you can see that monthly CPI number is certainly coming down. So we're on the right track. We are expecting inflation to be back into the target range by around about the middle of 2024. Certainly the second half of 2024. So we're on the way back, but still got a little bit way to go. Now, one of the big issues to keep an eye on here in Australia is wages growth. So wages growth, as in the first quarter of this year, was 3.7%. That's a 12-year high. And we can measure wages growth through our internal data as well, which is the chart on the left. And we think that means that wages growth will be around about 3.75% to 4% over the next year or so. There's clearly an increase underway in public sector pay, government workers, and also what is known as enterprise bargaining agreements, EBAs, as seeing an increase as well. So this is still one source of caution for the Reserve Bank. How high will wages growth go? Will that threaten the inflation target? That's one factor they'll be keeping a very close eye on. The other factor related to this is that measured labour market productivity has fallen in the last year or so, so quite weak. So we need to see an improvement in labour market productivity if we're going to see an increase in wages growth that is sustainable. And now I'm just going to talk a little bit about what's happening in the housing market. Very often, house prices in Australia are a big topic of discussion, and that certainly is the case at the moment, because house prices are rising again. Now, you can see from the chart on the left that we've had some big swings in house prices in the last few years. Big increase in the initial phase of the COVID period, when interest rates were cut aggressively, and then prices were very soft as interest rates have started to rise, but they're already rising again. They started rising in March. So house prices are rising before the Reserve Bank's tightening cycle ended. So the peak to trough decline in this cycle was about 10%, and prices are now up just close to 5% so far this year, or over the last 6 months. So we think they'll continue to increase, but probably at a more modest rate. The most recent data for July actually came out just the other day, and that showed a more modest increase. Now, one of the big issues here is, which you can see on the right-hand side, is approvals for housing have been quite weak. So the number of new buildings being approved to be built is too low. Now, if you combine a decline in the amount of new construction of dwellings, houses and apartments with an increase in population through net migration, well, clearly you have the recipe for higher prices. More demand through a big increase in net migration, less supply of new housing, and prices are rising. So this is likely to remain a key issue for Australia for many years to come. We can see here on the left-hand side, after increasing rapidly the amount of money that's being lent for housing, declined as interest rates went up, but is beginning to rise again. And you can see in the chart in the middle, we've had a big increase in interest rates being charged, but we think that that's now bottoming out. Now, there's always a lot of discussion about whether people are ahead of their mortgage repayments. How much is the higher interest rates going to impact them? And so we can see from this chart that a bit over 30% of all mortgage holders are ahead of their repayments by about 2 years. So they're well ahead of their repayments. As interest rates have gone up, they haven't had to increase their monthly funding of their mortgage. But well over 30% of people have no buffer at all. And in fact, if you look at the 1 to 2 months, 3 to 6 months, around about 50% of people now are having to increase their monthly repayments month after month after month as the Reserve Bank's been raising interest rates. And in round numbers, the average mortgage now costs about $1,500 more per month in repayments than it did before the Reserve Bank started raising interest rates. So there's a lot of tightening coming through the financial system in the housing market. Now, as I'm sure many people are aware, earlier this week, the Reserve Bank decided to keep interest rates unchanged at 4.1%. To be perfectly honest, we had thought they might raise interest rates this month, but they held them steady. So interest rates have now been held steady 2 months in a row, July and August. So this year we had increases in February and March, a pause in April, increase in May and June, then a pause in July and August. So we are now of the view that our base case is the Reserve Bank has finished its tightening cycle. The risk is still one more, but our base case is that they're done. And we think monetary policy easing will get underway around about March, April, May next year. Now, one of the really important factors here, as we talked about, is there's a big increase in interest rates coming through the system. The chart second from the left shows you we are at the peak of the fixed rate mortgage refinancing. So there's a lot of people who had an interest rate around about 2% who are going to have to switch that interest rate to something like 5 or 6%. You can see in the chart second from the right that total share of income required to service a mortgage is rising very sharply, and in fact is going to be at a decade high when all the rate hikes are factored into prepayments. And the chart on the right shows you that with the exception of Norway, Australia has seen the largest and fastest increase in the interest rate on the outstanding stock of mortgages. So even though the cash rate in Australia at 4.1% is quite a bit lower than the US and New Zealand and Canada and the UK, the actual tightening in the financial system is greater here than just about any other country. And so that's why we think the Reserve Bank can settle at a lower interest rate than many other comparable economies and achieve that inflation target without driving the economy down into recession. So that's the end of my prepared remarks. We have a rather large disclaimer, which I'm running through now. But what I'd like to do now is finish my prepared remarks and open up to questions. So thank you.
A reminder to all the audience, please send through your questions in the chat box on the right-hand side screen. Please, you will get a copy of today's presentation pack after the event by contacting your relationship manager at CBA or AustCham. If you wish to listen back to this session, you can also do so on demand after the closure of the call. Please send through your questions in the chat box. Hey, Stephen. The
Hello.
first question for you. You mentioned the difference between Australia and other global nations. Do you feel that difference will become more exaggerated or reduced as we see more countries heading towards recession?
Yes, a very good question. So I think we're likely to see that difference become more obvious. So as I mentioned, we are not forecasting a recession here in Australia. We are forecasting recession or near recession in quite a few other countries, including New Zealand, the US, Canada, UK. Part of the reason is the Reserve Bank here has not had to increase interest rates as much as other countries. And part of the reason is we are getting a good source of growth from our export sector, the mining sector, the agricultural sector, and business investment still looks like it's holding on quite well, both private sector business investment and government investment. So as we see significantly more slowdown in the economies like the US, Canada, UK, even Europe, the fact that Australia manages to stay out of recession, I think, will become more of a highlight for people around the world, and a very good outcome for us here in Australia.
Well, that's very good to hear. Here are a couple of more questions. Another one is, how come we have not seen price of homes falling in Australia, even with higher interest rates?
Very good question. So we did see prices fall through the initial phase of the increase in interest rates. So as I mentioned, from peak to trough, from around April last year to February this year, prices were down 10%. But that 10% decline followed an increase of around 20% through 2020, 2021. But a decline of 10% last year. But prices have started rising since March. And I think the two main factors there are people anticipating that the Reserve Bank's policy tightening cycle is at an end, but more importantly, a big increase in demand because of the surge in population, net migration, at the same time as the supply of new housing is too low. So the amount of turnover of stock, the amount of houses being put onto the market, both new and existing, is very low. And so with more demand and not enough supply, prices keep rising.
So here is another question. Do you expect the US rating downgrade by Fitch will have any impact on Australia or China?
So the short answer is no. As I mentioned, Australia's credit rating looks very strong. We have both a budget surplus and a current account surplus. And in fact, history has shown that credit rating downgrades for the US don't really have a lasting impact even on the US. They probably will heighten the focus on the US, budget and political system, which is not in good shape. But I think the long-term implication is very low for Australia and China.
A few more questions for you.
Yeah.
So there is a lot of change occurring at the Reserve Bank. over the next few months. What
Yeah.
impact, if any, do you think it will have on the markets?
Very good question. So I didn't talk about this in the speech, but there is certainly, as you say, a lot of change at the Reserve Bank. So through last year and early this year, the government initiated a review of the Reserve Bank, which is many other central banks have done over the years, and Australia had not had a review of the central bank for a few decades. So it makes sense to review these government institutions from time to time. Now, that review came back and recommended quite a significant change in the structure of the monetary policy decisions by the Reserve Bank. The establishment of what they've called a monetary policy board. So a new board set up to make the decision on monetary policy. That board would have 9 members, 2 members from the Reserve Bank, the governor and the deputy governor, 1 member from the Treasury, the Treasury Secretary, and 6 other independent members who are monetary policy experts. So this is a very similar structure to what exists in New Zealand and Canada and the UK. And it's no surprise because the lady who led the review is a Canadian who worked at the Central Bank of Canada and then worked at the Bank of England. And so they recommended this new board. The other recommendation was to move from 11 meetings in the year to 8 meetings in a year. So at the moment, the Reserve Bank of Australia meets on the first Tuesday of every month, with the exception of January. January, we're all on summer holidays, as people might know. So the other 11 months of the year, there was a meeting on the first Tuesday of the month. That's very unusual to have so many meetings. Most other central banks only meet every 6 weeks. So from February next year, the Reserve Bank of Australia will move to a new 6-week meeting profile every 8 meetings per year. The monetary policy decision will be announced at 2:30 in the afternoon. And then at 3:30 on the same day, the Reserve Bank governor will have a press conference. So this is very similar to the way the US Federal Reserve works. They announce the decision, then they have a media conference. So the Reserve Bank of Australia is moving structurally to a much more similar structure as what operates in the US, Canada, UK, New Zealand. The other really big change is, of course, that the current governor of the Reserve Bank, Philip Lowe, his contract expires in September and he has not been reappointed. So in September, we'll have a new governor of the Reserve Bank, who is the current deputy governor, Michelle Bullock. So Michelle Bullock is very highly regarded. She's been at the Reserve Bank for nearly 40 years. She is, as I said, very highly regarded by the markets, a very good communicator, very good economist. So her appointment has been greeted quite positively. The Reserve Bank will need to appoint a new deputy governor. They'll also need to appoint a new chief economist for the bank because the chief economist has left to go to another organisation. So there's a lot of personnel change. The deputy governor has been moved up. They'll need to appoint a deputy governor and a chief economist, and there's structural changes. So the question then is, does any of that matter for the outcomes of monetary policy? And my view is, even if we had all that structure and different people at the Reserve Bank for the last year or 18 months, the outcome of monetary policy probably would have been about the same. Interest rates needed to go up as they have everywhere. So I think we should expect the Reserve Bank of Australia to continue to be very consistent, very, with a high quality of deliberation and a high quality of communication. But it will be different under a new governor, Michelle Bullock. But I think she will do a very good job. So the impact on the market is unlikely to create more volatility in markets because we'll have a very strong decision-making process and lots of communication, including press conferences from the new governor. And I should say that that whole new system will start in February next year.
Hi,
yeah.
Stephen.
Any further questions?
Yep. There are a few more. So
Great.
we expect very positive implication from the new leaderships in the RBA. And do we expect any like interest rate cut or not at all?
Yeah. So as I mentioned earlier, so we think we've seen the last interest rate increase. The risk is maybe one more, but we think they've done. And then their mind will turn to how long do they need to keep interest rates up, and when can they start reducing them. So we think if the June rate hike was the last one, then the first rate cut could come as early as March next year. The meeting is the 19th of March, or the following meeting, which would be very early in very early in May, is when we think rate cuts could get underway. And we've penciled in 100 basis points of cuts through 2024. So 25 basis point easing every quarter through to the end of next year. So that would take the cash rate from 4.1% down to 3.1%.
Okay. We have a few more questions here, but given the concern of time, I'll just select 3.
Yeah, sure.
What are the concerns regarding the uncertainty in the Australian economy caused by international political factors?
So I think one of the big issues here is, of course, is our export exposure. And, of course, Australia exports the bulk of its exports up into the Asian region. So our major trading partners, of course, are China, Japan, South Korea, the growing importance of India. So these really big, Asian nations. So any geopolitical tensions in the region are important for us. Of course, as I'm sure many people on the call are aware, there's currently tariffs imposed on a number of Australia's exports into China. I think it's very welcome that over the course of the last 6 months or so, there's clearly been some improvement in the Australia-China relationship with very high-level meetings taking place. People may be aware that there's an invitation for our Prime Minister to visit China later this year. So, I'd like to think we're now moving in a much more positive direction. And if we can see the removal of those tariffs, that's going to be good news, I think, for both Australia and China. So there's definitely risks around those geopolitical factors, but I do feel like we're now things are moving in an improving direction, which I think will be would be beneficial for Australia.
Yes. And there is one question that many people are interested. What is your view on the rental growth for 2024?
Yeah. What I might do is try and bring up that chart on that. Just one moment, because that's a very good question. while that's coming up, let me just say, yes, so rental growth has gone up significantly. When I bring up the chart, you'll see it's growing at a bit over, there we are, the chart on the right-hand side there, the red line. So that's a measure of rental growth by one of the data companies. And you can see it's growing at over 10% per annum. So the big issue here is the lack of supply of new dwellings, particularly apartments, high density. And with the population rising, it looks like that the upward pressure on rents is going to remain in place, I would say, for at least another year or so, as we move to a more stable population growth rate and see some increase in new supply. But at the moment, there's a big disparity between demand and supply, and that's putting pressure on rents. The caution I would put there is that there is significant pressure on different governments to limit the increase in rents. So some of the state governments are introducing legislation to limit how much rents can go up and how often they can go up. So that's worth just keeping an eye on the government policy response to this upward pressure on rents due to more demand, not enough supply.
So I think it's time to hold your investment property tightly and not sell them easily at low price.
So I'm not allowed to give financial advice, so I'll leave it there.
Sure. And I'm afraid we are running out of time for the Q&A. But for audience who have other questions, please feel free to reach out to your relationship manager at CBA or AustCham. And that concludes our Q&A session. And now let's welcome Rex Chen, CEO of AustCham, and Lee Baker, the Chief Executive of CBA Hong Kong, for closing remarks. Over to you, Rex.
Thank you very much, Jeanette. We just heard a very comprehensive briefing. You don't need to hear another speech from me, even though the briefing wasn't exactly rosy, but nonetheless honest and helpful. And I think the sharing of such expertise is exactly the kind of value that Australian chambers want to provide to their members. So on that, I want to thank Steve. I want to thank the Commonwealth Bank of Australia, who is also our foundation member, for giving us this opportunity to hear straight from the horse's mouth on what we expect in terms of Australia's economy. We are very glad that we are hosting this event with our sister chambers in Shanghai and Hong Kong. I look forward to doing more of these events in the coming months. Thank you all.
Thanks, Rex, and thank you everyone for joining us today. In what's a volatile time for various markets, I hope today's session has provided you with insights to help drive success in your businesses. Thanks again for joining us, and have a great afternoon.